There are new tax rules involving trusts now in place. Under these rules, almost all trusts will require an annual tax return, even if they didn't before. Now, the deadline to file is March 31st, and the challenge is many Canadians may not even realize they have a trust. Here with more is Georgia Swan, tax and estate planner at TD Wealth. Georgia, always great to see you. Very interesting topic.
Thanks for having me back.
Let's dig into it. The CRA intends to move forward with these new trust reporting rules that they were out of the 2025 budget. Who is this going to impact?
It's going to impact a lot more people than we may think. So I'd like people to think about whether in the last couple of years they've done things like maybe added somebody onto ownership of one of their assets. Did they add a child onto one of their bank accounts, for example? Did they open an account with an intention that this account is for the benefit of somebody else? Now, it could be that it's just earmarked for a grandchild, for example, or maybe at the financial institution you've opened something called an in-trust account. It could also be with respect to real estate. Let's say, for example, you've done some changes in the ownership of your cottage, and the idea is that it's in somebody's name, one of your children's, for example, but everybody is supposed to benefit from it. These are the kinds of things that may have created a trust relationship, even though in your mind you didn't realize that's what it was. There's also some people that maybe know that they are in a trust relationship, but never had to file before, and they may not be aware that because of these new rules, now they do have to file.
Okay, Georgia, now we understand who may be affected. Talk to me about what's changing in terms of these reporting rules.
Basically, you should start from the position that nearly all trusts will have to file what's known as a T3 tax return for the 2025 taxation year. Now, while there are some exceptions that we'll talk about in a minute, I'd like everybody to start from that premise. And that T3 tax return, we're probably all familiar with T1s, that's the individual one, but this is one that is unique to trusts. Now, at a high level, the CRA is looking for transparency. They want to know who are the people or entities involved in these relationships. Who is the person that created the relationship in the first place? They're often referred to as the settler, but they're the ones that maybe transferred the initial assets. Who are the trustees? Who control these assets? Who are the beneficiaries? Who are these assets being controlled or held for? Basically, they want to know everyone that has any measure of financial control over the assets. In addition to that trust return, though, there may also be an additional schedule that has to be filed. It's called Schedule 15, a beneficial ownership declaration. People might be quite surprised, though, that there's some pretty comprehensive information that goes into that document. And as a result, the beneficiaries or other people that are involved in this relationship are going to have to help the trustee with the information that they need for it. Now, the other thing to remember is that the filing deadline is 90 days after the year end of the trust, which for most people is coming up really fast on March 31st. And while these new trust reporting rules were originally introduced a few years ago, they were also included in the November 2025 budget, which has now received third reading. So as far as the CRA is concerned, these rules are here and have to be adhered to.
Now, for the 2025 tax year, I am told that Bear Trust will be excluded and then be required to file the tax return in 2026. So walk us through those updated rules.
Yeah, so Bear Trusts are sometimes difficult to understand because the thing is they come up and they're created when people don't necessarily realize that they've been created. So for example, let's say I'm a senior and I add my child jointly onto my bank account because it's easier for them to access it if they have to buy my groceries, for example. So for most of us, we don't think anything of that. But in actual fact, in law, that is a bare trust. And so we have to really look at whether we've created these relationships. Maybe, I hesitate to use the word inadvertently because in the law there's certain requirements to create a trust, but we may not have realized we've done this.
I think I might know a few people in that situation. Apparently, though, there's going to be some enhanced exemptions as well that trusts can take advantage of.
Right. So when it comes to bear trusts, for example, if they have less than $50,000 of asset value, they may not have to file. For certain bear trusts where all of the people involved are in a close relationship to each other, like they're all parents and children, they have an enhanced exemption of $250,000 in asset value or less. And in certain circumstances where the asset is a principal residence, and again, there are relationship requirements for that, they may not have to file. So as I said, we start with the premise that all trusts have to file, and then we look to see if maybe we fall under one of these exemptions. The problem is, those exemptions are really complicated, not really a do-it-yourself thing. So really, you should try to get proper legal and tax advice to see if any of these apply to you.
So you're mentioning, obviously, this confusion around bear trust. You might need to speak to a professional. These new carve-outs, how do they address those concerns about how broad the original rules were?
Well, that's the problem. The original rules were really broad. So they brought in all of these like small bank accounts you had with your grandmother. And so that's what the carve-outs were meant to do, to give us some guidance, because, you know, that would have been hugely onerous for a lot of people that really should not have been caught by these rules. So those are the reasons that these carve-outs were brought in.
All right, so now we're talking about a deadline of March 31st. What happens if a required trust return isn't filed by then?
Then there is a penalty. And the penalty is basically $25 a day, up to a maximum of $2,500 or a minimum of $100 beyond that filing deadline. And if, however, you did not include all the information that was necessary in the T3 return, you may also be assessed a penalty from the date that the notice of assessment is issued. So, you know, if you have to file tax, if you have to pay tax, then if it's not paid by the deadline, you're going to have interest on it, but you may also have this penalty just because you didn't file.
Important stuff to know. Covered a lot of ground here. What is the key takeaway for Canadians who have trusts?
Don't assume that just because maybe you didn't have to file in the past, that you still don't have to file. You may now have to do this. Also, there's a lot of complexity. The goal of the CRA, as I said, is transparency and to get information. So you may now have to go to the other people involved in the trust relationship to get some of that information, and sometimes that can take time. So if you have a trust or you think you might be in a trust relationship, get proper legal and tax advice to make sure that you comply with the rules as you're required to.